Shocking. The widow's penalty, stealing $120,000 from your Social Security. Most couples plan retirement as a team, 2 checks, 2 standard deductions, wider brackets, but the system bills the survivor like they suddenly got a raise. That's the widow's penalty. And over a decade, it can quietly strip $120,000 through higher taxes, smaller net Social Security, and steeper Medicare premiums. Here's the twist most people miss. When one spouse dies, tax brackets shrink to single, one Social Security check disappears, and the Medicare IRMAA thresholds get cut in half. Same accounts, less income, bigger bills. Today I'll show you why this happens the moment one check stops, how it stacks up across taxes, Social Security, and Medicare, and the simple moves that cut the damage without changing your investments. There's one fix that works even if you never touch your portfolio. Stay with me, because the letters that arrive 2 years after a death are predictable and preventable if you know what to map now. Why this hits harder than you think. Let's start with the lie we tell ourselves. Costs will fall by half when one person passes. They don't. Housing, insurance, cars, subscriptions. Most fixed costs barely budge. Meanwhile, the survivor's income drops fast. One Social Security check vanishes, and only the larger benefit remains. That alone can cut monthly cash flow by 25% to 50% depending on who earned what. Now here's where the penalty bites. Filing status flips to single. Single tax brackets are much narrower than married filing jointly. If nothing else changed, that shift alone can push the survivor into higher marginal rates with the same pre-tax dollars. But things do change. Required minimum distributions keep coming from the survivor's IRAs and 401ks. Same balances, same or growing RMDs, just crammed into single brackets. That's a bigger tax bite on income the survivor often didn't even increase. Next, Social Security taxation. The government uses combined income to decide how much of your Social Security is taxable. Adjusted gross income plus non-taxable interest plus half your Social Security. The thresholds are archaic and not indexed. For singles, over $25,000 moves you into taxation, and over $34,000 means up to 85% of your benefit gets taxed. For married couples, the lines are $32,000 and $44,000. See the trap? As a widow or widower, you keep the larger benefit, but the thresholds collapse. Add the same RMD you had last year, and you can jump from little to no Social Security taxation to the full 85% zone in one calendar flip without raising your lifestyle. Then Medicare's IRMAA. Medicare looks back 2 years at your modified adjusted income to set your Part B and Part D premiums. In 2026, the first IRMAA line for singles is $109,000, exactly half of the $218,000 line for joint filers. Cross a bracket by $1, and you pay a monthly surcharge for the entire year. Practical translation. The survivor faces tighter thresholds with the same market-driven RMDs and any capital gains. You don't get more coverage for paying more. It's just a higher bill because your reported income crossed a line 2 years prior. Layer grief and paperwork on top of this, and timing becomes cruel. In year 1, you're handling the estate, notifying SSA, and adjusting withholdings. The real surprise bills land about 18 to 24 months later when that look-back sends IRMAA letters. The costs aren't random. They're delayed consequences of income the survivor couldn't easily control. There's one more emotional curveball. Many survivors delay changes out of caution. They keep investment allocations steady, defer withdrawals, and try not to rock the boat. But inaction lets RMDs snowball and bracket compression do the damage. The system punishes drift, not intent. Here's the good news. This penalty isn't a mystery. It's math. And math can be mapped. 3 forces do the harm: compressed tax brackets, the Social Security Combined Income Formula, and IRMAA's 2-year look-back with single thresholds. Once you see your numbers against these lines, you can plan. You can smooth income in joint years, use targeted Roth conversions below IRMAA cliffs, redirect RMD dollars with qualified charitable distributions, and fix withdrawal order so fewer dollars show up where they hurt. Before we jump to tactics, lock this in. The widow's penalty isn't about overspending, it's about measurement. The same dollars get counted differently after a status change. That's why it hits harder than you think until you put your situation on a single page and run it against today's thresholds. Once you do, the path to reducing the hit becomes obvious. And we'll start by breaking the penalty into 3 parts you can actually control. The triple hit: taxes, Social Security, Medicare. Let's stack the mechanics so you can see exactly where the money leaks. Part 1, taxes. When spouse dies, filing status shifts to single the next full tax year. Same IRA, same pension, same interest, but those dollars now flow through narrower brackets. If your joint taxable income fit comfortably near the top of the 12% or 22% range, compressing into single can push part of that same income into 22% or 24% without any lifestyle change. RMDs don't care about your filing status. They're calculated on last year's December 31st balances and the IRS life expectancy table. Markets rise, divisors shrink, and the required number grows. So even with one fewer Social Security check, the forced income can climb and get taxed at higher marginal rates solely because the bracket's squeezed. Part 2, Social Security taxation. The combined income formula is simple: AGI plus non-taxable interest plus half your benefit. But the thresholds are stuck in time. As a couple, many hover near the 32,000 or 44,000 lines. As a single survivor, the lines collapse to 25,000 and 34,000. Keep a larger survivor benefit, add even a modest RMD, and you're often thrust into the up to 85% taxable zone. Important nuance: up to 85% isn't a smooth ramp for many. Once you cross, the effective marginal rate on each additional dollar rises because that dollar drags more of your benefit into taxation. That's the torpedo effect. Practically, the survivor's net check feels smaller not because SSA cut it, but because the tax return pulled more of it into income. Part 3, Medicare IRMAA. Medicare prices Parts B and D based on modified adjusted gross income from 2 years prior. In 2026, the first surcharge hits single filers above $109,000. Joint filers get $218,000. That's the quiet having most people miss. Nudge over a bracket, even by $1, and the monthly bill jumps for the entire year. There's no extra coverage, just an income index surcharge. And because IRMAA reads your return on a delay, today's decisions forecast premiums 2 years from now. A perfectly normal RMD, a capital gain from rebalancing, or a one-time Roth conversion done without checking the line can trigger letters long after the funeral when you thought the dust had settled. Here's a quick micro story so you can feel the stack. A couple, Carol and James, lived on 2 Social Security checks totaling $54,000 and modest RMDs of $22,000. Joint, their combined income kept them near the 50% Social Security taxation zone and safely below IRMAA. James passes. Carol keeps the higher check, say $36,000, and her own RMD continues. Filing single, half the benefit adds $18,000 to combined income before counting the full RMD. That alone can shove her past $34,000, making up to 85% of her benefit taxable. Her marginal rate jumps because more benefit becomes taxable as each dollar lands. The next year, markets lift her IRA value, and the required withdrawal ticks up. 2 years later, Medicare reads those returns and bumps her Part B and D premiums into the first IRMAA tier. She didn't earn more. The system remeasured the same buckets. So how does this stack to the scary $120,000 headline over a decade? Think layers, taxes, a few thousand more per year from bracket compression and the Social Security torpedo, especially in years with rising RMDs, Medicare, $1,000 to $2,500 a year in surcharges when a bracket is crossed, sometimes more if multiple tiers are triggered over time. Add 10 years, add routine COLAs that raise your benefit, and ironically your combined income, add market growth that swells RMDs, and the math grows. It's not one dramatic event. It's steady drip plus occasional cliffs. Now here's where most people mess up. They track taxes and premiums separately. You need to see them as one line item called avoidable leakage. A single dollar of extra AGI can hit 3 places. It's taxed, it can pull more of your Social Security into tax, and it can threaten an IRMAA lying 2 years out. That's why planning by calendar year alone fails. The game is multi-year. What do you control? You can't control the survivor rules, but you can control what shows up as AGI. And when. That means mapping RMD trajectories, deciding whether to smooth income earlier while filing jointly, setting guardrails just under IRMAA lines, and using tools that satisfy rules without inflating AGI. We'll build your scorecard next, so you can see your exposure in one view and know exactly which levers to pull before those letters arrive. Your widow's penalty scorecard. Let's put your situation on one page. Grab a notepad or spreadsheet. Across the top, right. Income sources, combined income, AGI guardrails, IRMAA, bracket check. 3-year view, 10-year view, actions. First, list every account and income stream. Under RMD sources, list each traditional IRA. For 01K, for 03B, note the 12/31 balance and the coming year's required minimum distribution estimate. Add pensions, brokerage dividends/interest, annuities taxable portion, rental income, and any side income. In a separate row, list Social Security for both of you today and circle the larger check. That's the likely survivor benefit. Second, estimate. Survivor income. Assume one Social Security check stops and the survivor keeps the larger benefit. Write that annual number. Then add survivor RMDs from your list, pensions that continue, annuity income, dividends/interest, any part-time work. This is your baseline survivor cash flow before taxes and premiums. Third, run combined income, the way the IRS does for Social Security taxation. AGI plus non-taxable interest plus 50% of Social Security. For the survivor, have the survivor benefit and add it to projected AGI items, RMDs, pension, interest, dividends, plus any municipal bond interest. Compare the result to the single thresholds, $25,000 and $34,000. If you're over $34,000, assume up to 85% of the survivor benefit will be taxable. Mark this box red. Between $25,000 and $1 and $34,000, mark yellow. Below $25,000, mark green. Fourth, place your result against IRMAA brackets for single status using the 2-year lookback. For 2026, the first single threshold is $109,000 of modified AGI. Write the first 2 lines, $109,000 and $137,000. Then note your projected survivor magi. If you're within $5,000 of a line, mark it orange. If you cross it, mark red. Remember, a single dollar over the line triggers a full year surcharge for Part B and Part D 2 years later. Fifth, project a 3-year slope. Use conservative assumptions, 2 to 3% Social Security COLA, modest portfolio growth that nudges RMDs higher as divisors shrink. Fill 3 columns. Year 1, the first full single filing year. Year 2, year 3. For each year, estimate survivor magi. combined income, and whether you cross Social Security taxation and IRMAA lines. Highlight the first at-risk year. This is your letters arrive window. 6. Sketch a 10-year horizon. You don't need precision, you need slope. List ages, expected RMD growth, and any inherited IRA timeline if applicable. If non-spouse heirs will face the 10-year rule, note which year big distributions might hit and whether that overlaps with the survivor's single status. This is the tax torpedo zone that often appears in years 8 to 10 if distributions were delayed. 7th, add simple guardrails. Write 2 numbers in bold. AGI cap, the line that keeps you below the next IRMAA tier, and bracket top, the top of your current favorable tax bracket. These become your annual target lanes. If your projection overshoots the AGI cap by less than $5,000, consider minor pulls to land under it. If it overshoots by more, plan structural moves. 8th, capture quick levers under actions. Examples: withholding tune-up, shift to appropriate survivor status. Income smoothing while filing jointly, partial Roth conversions up to bracket top without crossing IRMAA. Qualified Charitable Distributions QCDs, from IRAs to satisfy RMDs without raising AGI. Withdrawal order tweaks, taxable first, then tax-deferred. Reserve Roth for flexibility and IRMAA control. Deduction bunching. Align big withdrawals with medical or charitable deductions. IRMAA timing awareness. Avoid 1-year spikes 2 years before Medicare adjustments. 9th, schedule a 30-minute pre-birthday pre-check each year. Update balances, recalc RMDs, refresh COLA, and rerun your 3-year and 10-year slope. Ask, are we under our AGI cap? Do we have bracket room to convert? Did any one-time events appear that threaten IRMAA? Finally, test a scenario. If the survivor is within $3,000 of the $109,000 IRMAA line, could a QCD, shifting a sale, or using cash reserves keep Magi under? If combined income is barely above $34,000, can moving $500 of non-taxable interest off the return or trimming a distribution tilt you back? Small dials, big outcomes. Once you see your slope and guardrails, the path to flattening the penalty is clear. Next, we'll time moves while you're both here to reduce forced income later. Timing moves while you're both here. This is where you buy the survivor breathing room. By reshaping income while you still have joint brackets, 2 standard deductions, and the wider IRMAA thresholds. Think of it as smoothing the hill now, so future you doesn't hit a wall. Start with income smoothing. Look ahead 3 years and spot your low-income windows, maybe the gap between retirement and claiming Social Security, or a year with unusually high deductions. In those softer years, pull controlled withdrawals from tax-deferred accounts on purpose. The goal isn't to pay more tax. It's to move dollars from future single brackets into today's joint brackets at known lower rates. If your projection shows you idling below the top of the 12% or 22% bracket, harvest just enough to fill that bracket without spilling into the next. That reduces the base your required minimum distributions are calculated on later. Now, the bracket filling Roth conversion. Same idea, different destination. Convert a slice of traditional IRA to Roth each year while filing jointly. Use 2 guardrails, your tax bracket top and the IRMAA thresholds for joint filers for 2026 planning. The first joint IRMAA line is $218,000 of Magi with a 2-year look back. Pick the lower of those ceilings and convert right up to it. You're trading a small, planned tax today for no RMDs on those dollars later, plus a survivor who can tap Roth without raising Magi that might trip Social Security taxation or IRMAA. This is especially powerful between ages 63 and 65 because conversions today influence Medicare premiums 2 years from now. Plan your amounts so future Magi stays under the next IRMAA tier. Sequence matters. If you have a taxable brokerage account, spend their first in early retirement, especially highly taxed interest. Realize capital gains deliberately in low-income years, keeping your magi below your chosen guardrail. Then trim the tax-deferred base with conversions. The combination lowers future RMDs, shrinks the Social Security tax torpedo risk for the survivor, and gives you a bigger Roth cushion for flexibility. Don't overlook the senior deduction window. Beginning in 2025, those 65 plus get an additional senior deduction layered on top of the standard deduction, and the age 65 add-on, subject to phase-outs. That extra cushion can absorb part of a planned withdrawal or conversion you do while both are alive. It won't erase the widow's penalty, but it softens the tax on the moves that prevent it. Build a withholding strategy so you're never penalized for doing the right thing. If you convert or withdraw, bump federal withholding on the transaction, or increase withholding on a pension, so you're safe harbored. Withholding is treated as paid evenly through the year, which helps avoid underpayment penalties even if you act late. For couples, align both spouses' withholdings to the year's plan. Now, the IRMAA dance. Because Medicare reads tax returns on a 2-year delay, map conversions with a calendar in hand. If you'll be 65 in 2028, your 2026 Magi is under the microscope. That means 2026 conversions should end comfortably below your chosen IRMAA line for joint filers. If you're already on Medicare, use smaller, stair-stepped conversions that stay under the next tier, rather than one big leap that triggers a full year of surcharges. Charitable. There's a cleaner route that doesn't require itemizing. Once either of you is 70 and a half, use Qualified Charitable Distributions directly from IRAs. QCDs satisfy RMDs, but don't increase AGI, which means they don't raise combined income for Social Security taxation or IRMAA risk. Turn your annual giving into a tax shield during joint years to protect the survivor later. We'll go deeper on QCDs next, but flag it now as an anchor tactic. Coordinate Social Security timing with your tax plan. Often, delaying the higher earner's benefit to age 70 raises the survivor benefit for life and creates more low-income runway in the 60s to do Roth conversions at favorable rates. Meanwhile, the lower earner might claim earlier to support cash flow while you execute the plan. The combo boosts the survivor's guaranteed income while lowering future forced income. Add a 1-year cash buffer. Park 6 to 12 months of expenses in cash or short-term treasuries. This buffer prevents panic withdrawals in down markets or unplanned sales that push Magi over an IRMAA line. It also lets the survivor avoid tapping tax-deferred accounts in a year that's already full. Finally, memorialize guardrails. On a single page, write our bracket top, our AGI cap just below the next IRMAA tier, and our annual conversion target range. Recheck each fall with current RMD estimates and the coming year's thresholds. When life happens, inheritances, home sales, big gains, ask one question before you act. Where does this land against our guardrails now and 2 years from now? That habit alone saves thousands. The system measures, therefore you plan. Smooth income in joint years. Convert in slices below IRMAA lines. Spend taxable first. Trim the RMD base. And use the senior deduction and smart withholding as cushions. You're not gaming the rules. You're pacing the income so the survivor isn't ambushed later. Donation that dodges the penalty. If giving matters to you, here's the cleanest way to turn generosity into a shield for the survivor. Qualified Charitable Distributions. A QCD lets anyone age 70 and a half or older send money directly from an IRA to a qualified charity. That transfer counts toward your required minimum distribution, but it never lands in adjusted gross income. Translation: you meet the RMD rule without inflating AGI, combined income, or IRMAA risk. Why this matters? Remember the triple hit: AGI feeds Social Security taxation and Medicare's look back. A normal RMD adds to AGI. A QCD doesn't. So every dollar you route as a QCD is a dollar that can't push more of your Social Security into the taxable zone or nudge you over a $109,000 single IRMAA line 2 years later. You're taking fuel away from the tax torpedo before it's lit. Here's the rule most people miss. The money must flow IRA to charity, not IRA to you, then to charity. Ask your IRA custodian for their QCD process. They'll issue a check payable to the charity or mail it directly. You'll still get a 1099-R that shows the full distribution, and on your tax return you report the total IRA distribution, but mark only the non-QCD portion as taxable. Simple wording, big effect. Practical setup. Make a one-page annual giving plan that matches your usual donations. If you typically give $5,000 across 3 causes, schedule 3 QCDs that total $5,000 and complete them early in the year. That way the first dollars you send out satisfy part, or all, of your RMD, without bumping AGI. Couple filing jointly? Each spouse can do QCDs from their own IRAs, once eligible. Guardrails and limits. You can QCD up to the statutory annual maximum per person from IRAs. Traditional IRAs are the usual vehicle. Employer plans generally need to roll to an IRA first. QCDs can't go to donor-advised funds, private foundations, or supporting organizations. Stick with public charities, faith communities, schools, and 501c3 nonprofits. A quick micro story. After Mark died, Linda kept giving to their church and local food pantry. In her first single year, her advisor shifted $6,000 of her RMD to QCDs. Her AGI fell by $6,000 compared to taking that portion as a taxable distribution. The combined income math kept more of her survivor benefit out of the 85% zone, and 2 years later she stayed under the first IRMAA tier. Same generosity, different path, smaller bill. 2 timing tips. First, if you plan other withdrawals, do QCDs early so the non-taxable portion clearly applies to your RMD for the year. Second, coordinate with any Roth conversions. Conversions increase MAGI. QCDs don't reduce MAGI below the conversion, but by shrinking taxable RMDs, they free up space in future years to convert without tripping IRMAA. This shines even if you take the standard deduction. Most retirees don't itemize, so writing personal checks to charity rarely lowers taxes. A QCD bypasses that problem by keeping the income off your return in the first place. You effectively deduct the gift at the top of the form where it protects Social Security and Medicare thresholds. Action step. Call your IRA custodian, ask for their QCD form, and pre-schedule this year's gifts. Then update your widow's scorecard. Subtract planned QCDs from projected RMDs, rerun combined income, and recheck IRMAA guardrails. You'll see the slope flatten immediately. The survivor's Roth, converting for the one who stays. Roth conversions are the lever that shrinks the widow's penalty at the root by reducing future forced income. The idea is simple. Move dollars from traditional IRAs into a Roth while you control the bracket and IRMAA exposure. Pay a known tax on purpose now to avoid unpredictable, bracket-compressed taxes, Social Security torpedoes, and IRMAA surcharges later, especially for the survivor filing single. Here's why this matters. Traditional accounts create RMDs. Roth IRAs don't. After a death, those same tax-deferred balances are crammed into single brackets and smaller IRMAA lines. Converting in measured slices while you're still filing jointly widens the lanes, uses 2 standard deductions, and lets you set the tax bill on your terms. The survivor then has a pool of tax-free money that never raises modified AGI, which means it won't drag more Social Security into tax or trigger IRMAA 2 years down the line. So, how do you do it without tripping the very cliffs you're trying to avoid? Use bracket filling. Pull up a current tax projection and note two ceilings, the top of your target bracket and the IRMAA threshold for joint filers. Your annual conversion target is the lower of those two lines. If your projection says you can add $28,000 of ordinary income and still sit below the bracket top and the $218,000 joint IRMAA line for 2026 planning, that's your slice. Do it again next year. And again, until the RMD base is meaningfully smaller. Timing is critical around Medicare. IRMAA uses a 2-year. Look back, so the conversion you do in 2026 affects your 2028 premiums. If you're approaching 65, keep conversions modest 2 years before, and the first year you're on Medicare. If you're already on Medicare, convert in consistent, stair-stepped amounts that hold you under the next IRMAA tier rather than spiking 1 year and paying a full year surcharge for the same coverage. Age also changes tactics. Before RMD age, conversions are pure offense. Every dollar you shift reduces future forced withdrawals. Once RMDs begin at 73, you must take the RMD first. RMD dollars can't be converted, but you can still convert the next dollars after satisfying the RMD, staying inside your guardrails. It's not as clean, but it still whittles the base and gives the survivor a tax-free reserve. Coordinate across spouses. While both are alive, aim to convert more while you have joint brackets and 2 deductions. If one spouse is much younger, consider the newer spousal election landscape for RMDs when deciding whose IRA to tap. The goal is fewer, smaller RMDs in the survivor's single years. Many couples power most conversions from the higher earner's IRA, which also boosts the survivor benefit by delaying that higher earner's Social Security to 70. Work the calendar with precision. Do a fall projection each year after RMD and withholding updates land. Confirm your distance to the bracket top and IRMAA line. Then set a conversion amount that leaves a small cushion. Think $2,000 to $5,000 under the line. Use withholding on the conversion itself if needed to satisfy safe harbor tax rules. Withholding is treated as paid evenly through the year, which can clean up penalty issues even with a December move. Pair conversions with smart withdrawals and QCDs. Spend taxable dollars first to reduce ongoing interest and dividend drag, freeing space for conversions. If you're charitably inclined and age eligible, use QCDs to satisfy RMDs without raising AGI. Then convert extra dollars above the RMD to chip away at the base. QCDs keep the Social Security and IRMAA math calmer. Conversions shrink the problem permanently. Heirs get a quieter result. 2. Under the 10-year rule for most non-spouse beneficiaries, inherited Roths can be emptied tax-free within 10 years, while inherited traditional accounts can produce big taxable spikes. Converting steadily now reduces the chance your children face that backloaded tax torpedo in their own high-earning years. Quick checklist to execute this cleanly. Map your 3-year Magi slope and write your bracket top and IRMAA guardrail in bold. Decide a conversion band, minimum and maximum, that keeps you comfortably under both lines. Convert after any RMD is taken for the year. Never try to convert the RMD. Set withholding or adjust a pension's withholding to cover the added tax. Reproject each fall. Thresholds and COLAs move, markets move, divisors shrink. A brief micro story. Dan and Marie retired at 66. They delayed Dan's Social Security to 70, claimed Marie's earlier, and converted $25,000 to $40,000 each year for 4 years, staying under the joint IRMAA line. When Dan passed at 78, Marie's survivor benefit was strong, her remaining RMDs were modest, and the cash she needed beyond those came from the Roth, tax-free and invisible to IRMAA. Her letters 2 years later, no change. That's the payoff you're aiming for. Smart withdrawal order for survivors. Here's the simple rule of thumb. Then we'll tailor it for survivors. Spend taxable, then tax-deferred. Preserve Roth. That order keeps your reported income lower, protects IRMAA headroom, and saves your most flexible dollars for when you truly need them. Start with Taxable. That's your brokerage account. Cash, interest, dividends, and realized capital gains. Why begin here? Qualified dividends and long-term gains often face lower rates, and trimming this account reduces future annual income that would otherwise hit your AGI every year. Keep the selling smart. Harvest gains in years you're clearly under an IRMAA line, and harvest losses to offset high-income surprises. Set a 12-month cash bucket inside Taxable, so the next year's spending is covered without forced sales in a down market. Next, Tax-Deferred. That's traditional IRAs and 401(k)s as a survivor. You'll likely have RMDs anyway, so satisfy those withholdings cleanly first. If you need more than the RMD, pull just enough to stay under your AGI guardrail and bracket top. Here's the twist most survivors miss. Aligning big withdrawals with big deductions is your safety valve. If you know a high medical year is coming, dental implants, surgeries, long-term care payments, use that year to fund extra from Tax-Deferred because the medical deduction can absorb part of the income. Same idea if you're charitably inclined and age-eligible. Use Qualified Charitable Distributions to satisfy RMDs without raising AGI. Roth is your control lever. Keep it intact for emergencies, market dips, and IRMAA control. Every dollar you pull from Roth never lands in modified AGI, never drags more Social Security into taxation, and never threatens a Medicare bracket 2 years from now. That invisibility is priceless once you're filing single. Use Roth for one-off needs. Home repair, family help, a car, especially in years you'd otherwise cross a line by a few thousand. Build a 1-year buffer. Survivors face irregular expenses, estate work, home fixes, travel to family. Park 6 to 12 months of spending in cash or short treasuries. When markets drop, spend the buffer and pause equity sales. When your projected MAGI is within $3,000 of an IRMAA tier, spend the buffer and avoid $1 over mistakes. Refill the buffer after you reset the tax year. Now, sequence within Taxable. First, spend cash and interest. Second, realize long-term gains with the smallest tax cost. Start with lots just above your basis to avoid big jumps. Avoid short-term gains unless necessary. Keep dividend payers you plan to hold. Selling them then rebuying later can add needless tax drag. In Tax-Deferred, satisfy your RMD early if it calms your planning, or spread it quarterly if cash flow feels steadier. If you do QCDs, execute them early so the non-taxable dollars clearly apply to the RMD. If you anticipate a medical deduction, cluster additional distributions in that year, then revert to the guardrail amount the next. 2 guardrails make this work, your bracket top and your IRMAA line. Write them on a card. Before any withdrawal, ask, does this push AGI past a cliff now or 2 years from now? If yes, look for a swap. Use Roth instead, accelerate a QCD, or split the withdrawal across December and January to straddle tax years without crossing a Medicare tier. Finally, automate the boring parts. Set monthly transfers from Taxable to your checking. Schedule RMD and QCD dates. Put a fall, AGI guardrails, check on your calendar. Survivors do better with fewer ad hoc decisions. This order, Taxable, then Tax-Deferred, preserve Roth, keeps more of every dollar off the forms that reprice your life. Combine it with your scorecard, and you'll feel the pressure drop immediately. The inherited IRA tax torpedo. Now, the landmine almost no one plans for. Inherited IRAs after the Secure Act. For most non-spouse heirs, adult children, grandchildren, the old stretch is gone. If they inherit your traditional IRA after 2019, they generally must empty it within 10 years. No required withdrawals in years 1 through 9 for many, but the clock runs. That sounds flexible until real life hits, people wait, balances grow. And then years 8 to 10 collide with peak earnings, higher tax brackets. And if the heir is your spouse, the survivor's compressed single brackets and IRMAA cliffs. That's the torpedo. Here's the mechanics. Under the 10-year rule, many heirs can choose when to take distributions, but the entire account must be zero by December 31st of year 10. Meanwhile, markets and dividends can swell the balance. If your heir delays, the required drain at the end is huge and fully taxable as ordinary income. For a surviving spouse, the dynamic shifts. Spouses still have unique options. Roll the account into their own IRA and take normal RMDs, keep it as an inherited IRA or under recent Secure 2. Changes elect to be treated as the decedent for RMD calculations in certain cases. The point isn't to memorize options. It's to see timing risk. Backloading withdrawals compresses income into the very years where single brackets and IRMAA thresholds are least forgiving. For the survivor, there's a double squeeze. Picture this. You already have your own RMDs. Then you inherit a traditional IRA from a sibling or parent. That inherited account follows the 10-year clock while your personal IRA keeps forcing annual withdrawals. Separately manageable, together they stack. One big distribution to meet the 10-year deadline can shove your AGI across a Medicare line by a single dollar and lock in surcharges for the entire year 2 years later. And because Social Security's combined income formula counts every extra dollar of AGI and half your benefit, that lump also pulls more of your survivor check into taxation. Same dollars, 3 impacts. Now, the common mistake. Heirs wait for a better market, or they aim to take it all in year 10, thinking they're being tax efficient by deferring. In practice, that creates a cliff. The tax bracket jumps, state taxes pile on, up to 85% of Social Security is taxable that year, and because of the 2-year look back, Medicare premiums explode later with no added coverage. That's the torpedo firing right when you want it calm. A quick micro story. Anita, a widow filing single, had personal RMDs around $24,000. She inherited her brother's $300,000 IRA at 74. She took nothing for the first 5 years. Markets were kind. The inherited balance grew to $360,000. In year 10, she withdrew the remainder to get it over with. Her AGI spiked, more of her Social Security became taxable, and 2 years later, her Medicare moved 2 IRMAA tiers for a full year. She didn't earn more. She waited and paid for it. So what's the better method? Create a yearly map the moment an IRA is inherited, divide the balance by the remaining years, and consider level withdrawals that keep you under your AGI guardrail and the next IRMAA line. If markets rally, peel a bit more that year and bank cash to reduce future pulls. If you have a high deduction medical year, use it to drain extra. If you're charitably inclined and age eligible, remember, QCDs only work from your own IRA, not an inherited one you received as a non-spouse. So satisfy your personal RMD via QCDs and reserve AGI room to pull from the inherited account without crossing a line. For surviving spouses with spousal options, choose with the end in mind. If you're younger than the decedent, a spousal rollover may lower annual RMDs by using your table. If you're older, keeping it as an inherited IRA and starting later might help, especially if it lets you avoid stacking both RMD streams in the same calendar years. The new spousal election framework can further align RMD calculations in your favor, get clear guidance, and model both paths before electing. The rule of thumb: don't let the 10-year clock force a single tax event. Spread withdrawals, coordinate with your bracket top and IRMAA guardrails, and use high deduction years as release valves. Miss that, and the torpedo finds you in years 8 through 10, right when single status already shrank the room you have to maneuver. Multi-year map, the March 5th 10 plan. Now, let's turn all of this into a simple map you can run once a year. Think in 3 horizons: 3 years for immediate guardrails, 5 years for Medicare and deduction timing, and 10 years for RMD and inherited IRA pacing. 1 page, clear targets, fewer surprises. The 3-year horizon is your control panel. Year 1, confirm filing status, survivor benefit, withholdings, and your AGI guardrail just under the next IRMAA line. Do a fall projection. RMDs, dividends, expected capital gains, and any conversions. If your projected MAGI is within $3,000 of the first IRMAA tier, plan a small dial, QCDs delaying a sale or pulling from Roth to finish below the line. Years 2 and 3, repeat the same fall drill with updated balances and the next year's thresholds. Each year, ask, do we have bracket room to convert without crossing IRMAA? If yes, convert a slice. If no, hold steady and use QCDs to neutralize RMDs. Here's the 3-year checklist you can read aloud. Recalculate combined income. AGI plus non-taxable interest plus 50% of Social Security. Set the AGI cap under the next single IRMAA tier. Fill bracket room with partial Roth conversions only if you stay below IRMAA. Execute QCDs early to satisfy RMD without raising AGI. Verify withholding meets safe harbor rules. Adjust if you convert late. The 5-year horizon is your scheduling tool. Medicare looks back 2 years, so label the calendar. What you do in year A sets premiums in year C. Use that spacing to bunch income in clear years and avoid spikes 2 years before a premium-sensitive year. Also bunch deductions. If you expect a high medical year, elective dental, joint replacements, long-term care premiums, group expenses in 1 tax year, and align larger tax-deferred withdrawals with that deduction cushion. Charitably inclined, stack bigger QCDs in years your RMD would otherwise push you near a line and shift personal gifts to other years. Add a simple rhythm. Years 1 and 2, hold MAGI under your IRMAA cap while you map survivor cash flow. Year 3, if you need a higher withdrawal, pre-bunch deductions, and proceed carefully. Year 4, return to a clean year. QCDs neutralize RMD. No large conversions if they risk year 6 IRMAA. Year 5, evaluate, then decide whether to repeat the cycle. The 10-year horizon is your glide path. Project RMD growth with modest market assumptions and shrinking divisors. If there's any inherited IRA with a 10-year clock, plot equal or stair-stepped withdrawals that keep you inside your AGI guardrail. Avoid deferral that forces a lump in years 8 through 10. Note ages that matter. 70 and a half for QCD eligibility, 73 for RMDs, and any survivor birthday that shifts life expectancy factors. Place a big star on the first full single filing year, and the year 2 IRMAA letters would reflect today's income. Create an annual AGI guardrails meeting, 30 minutes, same month each year. Update year-end balances, RMD estimates, Social Security COLA, and current thresholds. Rerun 3, 5, and 10-year columns with high/low assumptions. Decide. Hit stay the course. Hold delay moves or adjust convert/QCD/withdrawal order. Record 3 numbers in bold. Bracket top, IRMAA cap conversion target. Tools that make this painless. Basic tax software for what if, AGI, and combined income. A simple spreadsheet with rows for income sources and columns for years 1 to 10. Your custodian's QCD forms. And an auto-pay calendar reminder. A 1-page worksheet taped inside a folder labeled guardrails. A quick micro-story to show payoff. Susan ran this map at 71. In her 3-year panel, she saw MAGI drifting $2,400 under the single IRMAA line. She did $18,000 in conversions twice, stayed below the cap, and used QCDs to cover the rest of her RMD. In her 5-year panel, she marked a hip surgery year and clustered withdrawals there. In her 10-year panel, she spread an inherited IRA over 8 equal polls instead of one big end-year drain. 2 years later, the Medicare letter said, "No change." 3 years later, same line. She didn't change investments. She changed timing. Remember the rule. Plan in seasons, not snapshots. 3 years keeps you safe. 5 years keeps Medicare quiet. 10 years prevents the torpedo. 1 page once a year, hit, hold, or adjust. That's how you keep critical deadlines and documents. Here's the boring but critical part that saves real money: dates, forms, and which papers to update first. Start with Social Security survivor benefits. You don't get them automatically. You must contact SSA. If the higher earner dies, call Social Security promptly to claim the survivor benefit. You can apply online for most survivor benefits, book an appointment, or visit an office. Ask 2 things: the start date options and whether a small delay to the first day of the next month improves the monthly amount. Also decide how much tax withholding you want from benefits, Form W4V. If you expect more of the check to be taxable as a single filer, set withholding now so April doesn't sting. Next, filing status changes on your tax return the first full tax year after death. In the year of death, you'll usually file jointly if you didn't remarry. The following year, you'll file single unless you qualify as a qualifying surviving spouse. Put a reminder on your calendar. Update your tax organizer to single for the next tax season. Adjust estimated payments or withholdings accordingly. RMD deadlines matter. The year of death has special rules, but for survivors with their own IRAs, your regular RMD must still be withdrawn by December 31st each year. If you inherited accounts, the choice you make, spousal rollover inherited IRA or the spousal election framework, affects timing. Don't miss December 31st. If the decedent died after their required beginning date and hadn't taken their full RMD for that year, be sure the remaining amount is distributed by December 31st of the year of death. Mark it. RMD status check every October. Beneficiary designations are a non-negotiable audit. IRAs, 401(k)s, annuities, transfer on death brokerage, and life insurance. Pull each statement and confirm the primary and contingent beneficiaries. Update immediately if they no longer reflect your wishes. This bypasses probate and sets up simpler transfers later. Tax withholding tune-up. After the status change, file a new Form W-4 for any pension or job income, and a new Form W-4P for retirement distributions you control. If you'll use Roth Conversions or bigger withdrawals, increase withholding to meet safe harbor rules. Withholding is treated as paid evenly across the year. Use it to avoid underpayment penalties, even with late year moves. Medicare IRMAA appeals. If your income dropped due to a life-changing event like the death of a spouse, you can ask Social Security to adjust your IRMAA. Use Form SSA 44. You'll list the event, estimate current year income, and attach proof, death certificate, income documents. This won't undo past surcharges, but it can lower what you pay going forward. Paper trail checklist you can do in one sitting: death certificates, order 10 to 12. SSA, appointment confirmation, and W-4V for survivor withholding, custodian RMD status, and QCD forms if age eligible, beneficiary confirmations, IRAs for 401(k)s, annuities, life insurance, TOD accounts, updated W-4 divided by W-4P for withholding, SSA 44 packet if IRMAA relief applies. A simple AGI guardrails, one-pager taped in your folder. Deadline snapshot, December 31st. Years, RMDs, QCDs, deduction bunching moves. January 15/April 15th. Estimated tax payments, if needed. 2-year IRMAA look back. Decisions this year affect premiums 2 years out, Note your Medicare open enrollment letter months. Lock these dates and documents now, and your planning tactics actually stick, and the letters that arrive later say no change. The 12-month survivor protection checklist. Month 1, get your bearings and stop leaks. List all income sources, current monthly expenses, and cash on hand. Estimate this year's survivor income. Survivor Social Security, RMDs, pension, annuity, interest/dividends, and any wages. Call Social Security to confirm the survivor benefits start and file Form W. 4V for withholding if needed. Order 10 to 12 death certificates. Create a folder labeled AGI Guardrails. Month 2, reset tax and Medicare basics. File new withholding forms, W4P for pensions/distributions, reflecting single status next year. If your income has dropped due to your spouse's death, start the SSA 44 IRMAA appeal packet. Gather documents now, even if you'll submit later. Put a reminder on your calendar. IRMAA appeal, submit when tax return is filed. Month 3, build cash buffer and map your 3-year slope. Set aside 6 to 12 months of essential expenses in cash or short treasuries. Run your combined income math, AGI plus non-taxable interest plus half of survivor Social Security. Compare to single thresholds $25,000 $34,000 and mark your color zone. Write your AGI guardrail under the first IRMAA tier. If you're within $3,000, circle it. Month 4, turn giving into a shield. If you're 71.5 plus, set up QCDs at your IRA custodian to satisfy part or all of your RMD without raising AGI. Draft a 1-page annual giving plan. Execute the first QCDs early so they clearly count toward this year's. RMD. Update your scorecard with the reduced taxable RMD. Month 5. Take your first Roth conversion slice if room. Do a mid-year projection. Confirm distance to your bracket top and the IRMAA line. If safe, convert a measured amount. Leave $2,000 to $5,000 cushion. Use withholding on the conversion to meet safe harbor rules. Note, if you'll be 65 in 2 years, keep MAGI comfortably below the IRMAA threshold now. Month 6, top off the cash buffer and stress test. Refill the 12-month cash bucket from Taxable if markets are cooperative. Harvest long-term gains if you remain under your guardrail. Stress test your plan with a what-if year. A large medical bill, a car replacement, or a home repair. Decide which account you tap. Roth first if an IRMAA line is at risk. Month 7, IRMAA bracket check and calendar forward. Update your MAGI projection using year-to-date income and expected dividends. Rerun your 2-year look ahead. This year's MAGI sets premiums 2 years from now. If you're drifting over a line, plan dials now. Accelerate QCDs, delay a sale, or pivot the next withdrawal to Roth. Month 8, medical and deduction timing. If you anticipate large medical expenses this year, bunch them intentionally. Align any extra tax-deferred withdrawals with the medical deduction cushion. If not, keep withdrawals trimmed to your guardrail. If you're charitably inclined but not QCD eligible, consider bunching gifts this year and taking the standard deduction next year. Month 9, beneficiary and estate hygiene. Review and update beneficiary designations on IRAs for 01(k)s, annuities, life insurance, and transfer on death brokerage accounts. Confirm contingent beneficiaries. Note any inherited IRAs. Establish a 10-year distribution map to avoid a year 10 tax cliff. File and organize statements in your guardrails folder. Month 10, project next year and set guardrails. Pull estimated RMDs for next year, Social Security COLA, and plan distributions. Set next year's bracket top, an IRMAA cap. Draft a conversion band for next year, minimum and maximum. Decide. hit convert/QCD, hold coast, or adjust bigger QCDs, smaller conversions. Month 11, withholding tune-up and RMD cleanup. Confirm all RMDs are satisfied, including any inherited accounts. Execute remaining QCDs if needed. Adjust year-end withholdings to avoid penalties. If you're within $1,000 of an IRMAA line, pivot late year withdrawals to Roth or cash to finish under the cap. Month 12, set the next year on autopilot. Schedule monthly transfers from Taxable for living expenses. Calendar your AGI guardrails meeting for early fall. Pre-schedule QCDs for the year. Set reminders for SSA 44 filing if an appeal applies. Write your 3 numbers bracket top IRMAA cap conversion target on a card and clip it to your folder. Quick wins. Do 1 call and 1 paper each month. Month 1, Social Security and W-4V. Month 2, W-4P and IRMAA checklist. Month 3, cash buffer. Month 4, QCD setup. Month 5, conversion slice. Month 6, gain harvest or refill cash. Month 7, IRMAA check. Month 8, medical bunching. Month 9, beneficiaries. Month 10, next year guardrails. Month 11, RMD cleanup. Month 12, automation. Already lost a spouse and feeling behind? Start at month 1 this week, then double up months 1 to 2 next week. The sequence matters less than building the habit. Project, guardrails, dials, repeat. This checklist keeps you under the lines that reprice your life, and it buys back calm 1 month at a time. If you're already a widow/widower, triage steps. If you've already lost a spouse, start with a calm, focused triage. First, recalc your income math right now. List your survivor Social Security, RMDs, pensions, annuities, dividends/interest, and any work income. Run the combined income formula. AGI plus non-taxable interest plus half your survivor benefit, if that lands above $34,000. Assume up to 85% of your benefit will be taxable. Between $25,000 and $1 and $34,000 is the 50% zone. Circle your result so you know what your return will likely do. Next, check your IRMAA exposure. Look 2 years forward from this year's Magi. 4 single filers. The first IRMAA line is $109,000. If your projection sits within $3,000 of that, you're in the risk zone. Write your cap number on a card and tape it by your desk. Every withdrawal decision needs to respect that line. Now handle this year's RMDs. If your spouse died after their required beginning date and didn't complete their RMD, make sure the remainder is taken by December 31st. For your own IRA, confirm your RMD schedule and method. If you're age 70 and a half or older, consider using Qualified Charitable Distributions to satisfy part or all of your RMD without raising AGI. QCDs go IRA to charity directly. Ask your custodian for the form, and they're one of the fastest ways to keep combined income and IRMAA risk down. Bunch deductions if you can. If this is a high medical year, dental procedures, long-term care premiums, consider pulling slightly more from tax-deferred accounts while those expenses push your medical deduction higher. That lets you fund needed cash flow with a lower tax bite. If you're charitably inclined and QCD eligible, execute those gifts early so they clearly count toward this year's RMD. Do a withholding reset so April doesn't surprise you. File a new W-4P for pensions or a quick withholding instruction for IRA distributions. If you make a late year withdrawal, you can direct extra withholding there. Withholding is treated as paid evenly across the year and can clean up underpayment penalties even in December. For Social Security, file Form W-4V if you want federal tax withheld from your monthly benefit. Appeal Medicare IRMAA if your income dropped because of your spouse's death. Use Form SSA 44, list death of spouse as a life-changing event, and provide the death certificate and updated income info. This won't refund past surcharges, but it can lower what you pay going forward. Put a reminder to revisit the appeal after your first single return is on file. Fix beneficiary designations immediately. IRAs for 401(k)s, annuities, life insurance, and transfer on death brokerage accounts. Confirm primary and contingent beneficiaries reflect your wishes. This keeps money moving cleanly later and prevents assets from getting stuck in probate. Build a 1-year cash buffer so you aren't forced into taxable withdrawals at the worst time. Park 6 to 12 months of expenses in cash or short treasuries. When the market dips or you're near an IRMAA line, draw from the buffer and wait to refill when the calendar turns. Choose a smart withdrawal order for this first year. Spend taxable cash and interest first, then realized long-term gains in measured amounts, then just enough from tax-deferred to meet your RMD and stay under your AGI cap. Preserve Roth for flexibility and IRMAA control. Use it to avoid crossing a line by a few $1,000s. If you inherited a retirement account from someone else, not your spouse, map the 10-year clock now. Don't wait for year 10. Divide the balance across remaining years in even or stair-stepped polls that hold magi under your guardrails. If you expect a big medical year soon, plan to drain more then. Set 2 standing dates in your calendar. In October, run a fall projection. RMD status, year-to-date dividends, expected capital gains, and your distance to the IRMAA line. In early January, set your AGI guardrail, pre-schedule any QCDs, and decide whether you have room for a modest Roth conversion without tripping a tier. 1 page, 2 meetings, fewer surprises. You can't change the survivor rules. You can control what shows up on your return and when. Recalc, cap, QCD, bunch, withhold, appeal, and buffer. That's the triage that keeps more of every check in your pocket. Micro moves that save thousands. These are the tiny dials that quietly keep money in your pocket. No big overhauls, just clean execution. Start with smart estimated taxes. If you take mid-year distributions or do a Roth conversion, use withholding on that distribution instead of separate estimates. Withholding is treated as paid evenly through the year, which can erase underpayment penalties even in December. If you prefer estimates, follow safe harbor rules. Generally 100% of last year's tax, 110% for higher incomes. So you're protected if income pops late. Tune your Social Security and pension withholding. File Form W, 4V to withhold 7%, 10%, 12%, or 22% from Social Security, and a W-4P for pensions or IRA annuity payouts. After you switch to single status, bump withholding to match your new bracket and the portion of Social Security that will be taxable. This keeps refunds small, surprises smaller, and IRMAA cash flow stable. Time capital gains with your guardrails. Look at your 1099 dividends and year-to-date sales in the fall. If you're comfortably under your IRMAA line, harvest long-term gains you were going to take anyway, especially lots with small gains, to reset basis for future flexibility. If you're within $3,000 of a Medicare tier, skip the sale or split it across December and January to straddle tax years without crossing a line. Use Roth as your pressure valve. If an expense appears late in the year and your magi is brushing an IRMAA threshold, fund it from Roth. Those dollars never hit AGI, never pull more of your Social Security into tax, and never trigger a 2-year later surcharge. Refill the Roth only when you have room under next year's guardrails. If you have an HSA and are still eligible, deploy it intentionally. Pay routine medical out-of-pocket and let the HSA grow. In high deduction years, major dental surgeries, reimburse yourself from the HSA tax-free. That replaces taxable withdrawals you would have needed and helps you stay under IRMAA in a year that was already tight. freeze auto pays and audit subscriptions. After a spouse passes, small monthly drafts slip by. Cancel duplicates, streaming, cloud storage, club fees, and redirect that cash to your 1-year buffer. Add fraud alerts and account activity emails. Less leakage means fewer withdrawals, which keeps your Magi calmer. Update every beneficiary form. This isn't just estate hygiene, it's tax control. Properly titled IRAs and transfer on death accounts move quickly, reducing the chance you'll need large, taxable estate cash calls in a bad year. Confirm contingents. 2 simple, zero-cost insurance for clean transfers. Nudge dividends toward cash when you need runway. If your taxable account automatically reinvests dividends, switch to cash distributions for a year. You'll fund spending without selling shares, lowering capital gains realization, and keeping AGI smoother. Turn reinvestment back on when your cash bucket is full. Schedule a 2-year look ahead every October. Write this year's projected Magi, then write +2 next to it. That's the Medicare year those dollars will price. If the number is too close to a bracket, pivot the last moves. Accelerate QCDs, delay a mutual fund sale until January, or cover a purchase from Roth or cash. Trim non-taxable interest if it tips your combined income. Remember, municipal bond interest is included in the Social Security combined income formula. If you're barely over the $34,000 single threshold, consider swapping a slice of muni funds for short treasuries or CDs. The yield shift may be small, the taxability math can be big. Align big checks with big deductions. Plan elective dental or hearing costs in the same year you'll need a larger withdrawal. The medical deduction can absorb part of the income, letting you fund cash flow without crossing an IRMAA line. Next year, return to your lean, QCD first rhythm. Finally, keep a guardrail card in your wallet. Bracket top, IRMAA cap, and conversion band. Before any withdrawal or sale, glance at the card and ask, does this push me over a line now or 2 years from now? That 5-second pause is the cheapest insurance obstacle you'll ever buy. Ken and Marjorie did what most careful couples do. They retired at 66, paid off the house, and set one goal: steady checks and simple taxes, so they could travel twice a year and help the grandkids with college. Their plan looked tidy: 2 Social Security checks, a modest pension, plus IRAs they barely touched. The intention was clean: live on predictable cash flow, and let the nest egg ride. Then the obstacle hit. Marjorie passed unexpectedly at 74. Overnight, their tax world rewired itself. Ken kept the larger survivor Social Security check, but the second check was gone. What didn't disappear were the RMDs on the same balances they'd built together. Now he filed single, which meant narrower brackets, a tighter IRMAA line, and the same portfolio dividends landing in a smaller lane. That first spring, his tax bill rose even though his lifestyle hadn't changed. 2 years later, Medicare read the higher income on his old return and bumped his premiums. It felt unfair because he didn't earn more. The system just measured him differently. Here's what they missed while both were here. They had a gap low-income windows before RMD age, and during the years they delayed the higher earners' Social Security. That was prime time for bracket-filling Roth conversions under joint brackets and the wider joint IRMAA line. They also gave generously, but from checking, QCDs would have satisfied RMDs without touching AGI, keeping combined income and IRMAA risk lower. Finally, their withdrawal order kept taxable dividends growing. Spending taxable first and trimming the tax-deferred base would have lowered future forced income for the survivor. Ken fixed it with 3 moves. First, he set guardrails: a single filer AGI cap just under the first IRMAA tier, and his bracket top. He wrote those numbers on a card next to his desk. Second, he pivoted to QCDs, his church and pantry gifts, About $7,000 went IRA to charity early each year, knocking his taxable RMD down by the same amount and keeping more of his survivor benefit out of the 85% zone. Third, he created a multi-year map. He spread an inherited IRA over the remaining 7 years, equal pools that stayed under his cap. Instead of waiting for a year 10 dump in a high medical year, he aligned extra distributions with the deduction cushion and then returned to a lean rhythm. He also preserved his Roth as the pressure valve. When a late-year roof repair threatened to push AGI over the line by a few thousand, he paid from Roth. No Magi change, no future IRMAA letter. And he automated the boring parts, monthly transfers from taxable, scheduled RMD/QCD dates, and a fall AGI guardrails check. The payoff showed up exactly where you'd want it. 2 years after he replumbed the income, his Medicare letter said, "No change." He didn't change investments. He changed timing, order, and paperwork. The lesson is simple. Intention alone, steady checks and simple taxes, isn't enough if the survivor's math isn't built in. The obstacle is structural. Single brackets, combined income rules, and IRMAA look back. The fix is structural too. Convert in slices below lines while both are here. Donate via QCDs. Spend taxable first. Align big pulls with big deductions. And keep a Roth buffer for when you're inches from a cliff. Do that, and the survivor keeps the routines and travel you planned for without surprise bills 2 years later. The 30-day protection protocol. Week 1. List every income source and run the combined income math. AGI plus non-taxable interest plus 50% of Social Security. Note your bracket top and the IRMAA line that applies 2 years ahead. Week 2, set guardrails, an AGI cap just under the next IRMAA tier, and a conversion band that stays below your bracket top. Create a 1-page scorecard and tape it in your folder. Week 3. If 71.5 plus, set up QCDs and schedule this year's gifts IRA to charity. If not, set a measured Roth conversion target that leaves a $2,000 to $5,000 cushion. Week 4. Update withholdings W4P/W4V or on the conversion to meet safe harbor. Calendar a fall AGI guardrails meeting. The payoff. When the letter arrives, it says no change. Keep what you earn. The key takeaway. You can't stop the survivor rules, but you can control what lands on the return. And when guardrails, QCDs, bracket filling conversions, smart withdrawal order, and a simple yearly map. If this helped, finish the 30-day protocol and drop your win in the comments. Then watch the IRMAA Time Bomb Deep Dive to lock your Medicare savings and subscribe for the follow-up checklist. Small steps now prevent a $120,000 loss later. Start today.